Welcome to my conversation on accessing outside capital for your business. As I move through this discussion, if you have any questions, please go to ibossinc.net and you'll see a tab to send a voicemail. Let me start by thanking you for sharing this time with me. My name is Lorette Farris. I am a former business broker, mergers and acquisition specialist, and investment banker. So I think that qualifies me to have this discussion. My firm is iBoss Inc. I am its CEO and business strategist. At iBoss, we help companies raise investment capital through teaching, training, and direct advisory services. So, I am challenging myself to increase each of your curiosity just enough that you will want to do some research. And I look forward to each of you holding my feet to the fire through any questions you might have. So let's begin. We work within a niche market that includes startup and early stage companies with business and revenue models that are designed for high growth and income, and that are seeking to raise capital from investors in the equity markets. I will feel that I have successfully conveyed my message today if at least a handful of the participants leave the hearing of this message and seek further information. For business founders, your most important job is to appropriately capitalize your business for, amongst other things, the purpose of bringing into manifestation what you have laid out in your business plan. And so, in order for you to do that, you must learn all the options available to you as you attempt to fulfill this great responsibility of capitalization. So how do you begin? Well, your first step is to learn what the options are, from debt to equity through revenue share and various other vehicles. The next step is to learn who is on the other side of each of these options, who holds the purse strings. Then, learn the variations available within each of the options and what each participant requires of you. So, within each step I just mentioned, there's one steadfast thread, and that's learn. I highly recommend you take some time to ensure that you know not only what vehicles for financing are available, but of those vehicles, which ones make sense for you, your project, your stage of operations, your long-term aspirations, and your eventual exit strategy. These are the high-level categories that help to drive the determinations made by those with the capital you're trying to get. We have coined a phrase for these days, and that is the new capital markets, to put a pin in the fact that times have changed. New security regulations and financing vehicles have aligned with technology to make accessing capital a process you get to determine, and it's only limited by your imagination. No longer are you relegated to obscurity because your friends and family will not open their purses anymore, or because the bank said no, or because you don't have what it takes to interest venture capital. Most of us understand debt, knowing that generally means loans, which conjures up thoughts of traditional banks. Well, just know, there are so many more options available. There's various alternative lending mechanisms that are now considered part of mainstream financing. Accounts receivables and contract financing, peer-to-peer lending and convertible notes, just to name a few. And while you might not qualify for one, you might qualify for a few of the others. Next, there's revenue sharing, which is kind of understood, at least to the point that one understands that as you sell your products or services, a portion of the revenue will be shared with the lender. But do you understand how powerful that could be in leveraging how you build a robust deal structure to interest those with the capital that might not otherwise consider what you have to offer? Then, what is least understood is equity. First, what type of projects can interest an investor to want to provide capital for a piece of the business? But more importantly, how significant it is when you do begin to bring in outside investors. They don't only provide money, they provide expertise and resources that can move your business much faster than you can do alone. Don't limit your growth by being afraid that someone wants to take your baby. Having 100% of nothing versus 70% or 50% of a whole lot is the mindset that you may need to learn. You see, investors are willing to share all sorts of information and contacts to help position you to get business you might only dream of, at least when you know how to engage with the right investors for your business. When their money is in, they have a vested interest to see it all work out. This is the side of accessing capital that I will focus on, but in no way am I suggesting this to be the only way to capitalize your business, which is why I started this conversation with strongly suggesting that you relook at all of the available options, even those you believe you already understand. In today's new capital market, there are so many new opportunities that have surfaced that may add some nuance to a process that you may not be aware of. So, as it relates to investment or the equities market, today's buzzword is crowdfunding. First, there is the GoFundMe, Kickstarter, and Indiegogo models that speak to rewards and donation-based funding, though of late they do some equity. Then there are the various state regulations that provide for intrastate equity-based financing. Many states felt compelled to enact their own regulations as the SEC opened the door and now has acted on the crowdfunding regulation. Then there is the process of raising capital that crowdfunding speaks to that I will be talking about. For instance, there are provisions of the Jobs Act of 2012 that President Obama has passed and that the Securities and Exchange Commission, or the SEC, has implemented that allow companies to raise unlimited capital from the general public through the means of general solicitation, lightly said, which is marketing. Whether they are selling to accredited or high net worth individuals or non-accredited individuals, non-high net worth individuals. These new regulations, coupled with technology and various online platforms, position you to have direct access to investors that are looking for good startup and early stage companies that make sense for their investment appetite. Specifically, one of the provisions provides for marketing of private placements and another for direct public offerings. In layman terms, with the private placement, you can raise, say, seed capital of $250,000 to $1 million that you need to get your business going. Or with a direct public offering, you can raise upwards of $50 million in a manner that allows your customers, friends, and family to share in the ownership of your project for as little as $100. This is definitely a glossed over description, but the visual is real and doable in this new capital market. It's up to you to learn about it. Again, your job is to learn what is entailed in these regulations and how you can leverage them and the available technologies to help you capitalize your goals. Just know, it all starts with something you have heard over and over again. And yes, that is, it starts with your business plan. As cliche as you might think that is, just know that to be considered serious by any financial resource, whether it's a bank or whether it's an investor or whether it's grants, without a business plan, you are just another conversation. Now, when you are talking about an individual or sophisticated investor taking money out of their pocket and putting it into yours, you have to provide them with a compelling reason to do so. When developing your business plan and assessing how much capital you need to execute it fully, that's when knowing all the available options comes into play. That's where you start to build a structure of the type of capital you require, where to best seek that capital, and what terms would be required to satisfy that capital provider. Will it be debt with terms of paying back the loan or servicing the debt? Or will it be equity with the terms of shared ownership? Or perhaps a hybrid of the two, a convertible note? Learn how each impact your business in both the short and long term. Determine the types of exit strategies that make sense for you as well as your financial partner. Are you looking to build a business to eventually be taken over by a family member, or are you looking to grow to a point of becoming an acquisition candidate to be bought by a bigger concern, or are you looking to eventually take your company public through an IPO? These are all considerations you need to be aware of from the beginning. Yes, you have to consider your exit strategy even when you're just putting together your business plan. You see, you build to your exit. If you want to eventually become a lawyer, you go to law school to build on the knowledge needed to become a lawyer. Similarly, if you want to be bought by a bigger company, you build your business to look like a company they would buy. Not only does an investor need and want to understand how they are going to exit your business or get their money back, you see, when you work for someone else, they determine your exit strategy by your retirement plan. But when you work for yourself, you determine your exit strategy. Will it be succession by a family member, or acquisition by a third party, or perhaps an IPO via a public offering? Now that we've dealt with the planning part, it's time to take action. What steps are you going to take toward your capitalization strategy? And again, in my wheelhouse, that means how do you go about finding these elusive investors that might be interested in what your business opportunity has to offer? Well, you can't sell until you have someone to sell to, right? And unless you have significant relationships with those that have money to invest, you now must learn how to develop a database of potential investors. This is merely a process. It may be time-consuming, but it's a process nonetheless. Think about how you put together a marketing plan to target and sell your products and services to your audience of customers. Similarly, you develop an action plan to engage likely investors to invest in your project or idea. Like with customers, you don't normally have overnight success. Neither will you with potential investors. It is a process that you learn to hone the necessary skills. Identify the targets, plant the seeds, nurture the relationships, and then close the deal. So first, identify the target. This goes back to learning. Once you understand which available options make sense for your stage of operations, you then need to determine what tools are required of you at that stage. Then you can begin to search for the persons, groups, and organizations that are interested in one, your organization and/or genre, such as a service business, organic foodie, technology firm. 2, interested in. Then those that might be interested in the capital you're seeking. Are you pre-revenue and looking for somewhere in the $250,000 to $1 million range? Or do you have a proof of concept with some sales revenue and are seeking upwards of $5 million? The point here is that you have to do your homework so that you are engaging with investor prospects whose investment appetite matches your investment offering. Then you plant the seed. As with most things in life, nothing happens all of a sudden. Oftentimes, we don't pay attention to cause and effect of circumstances and are quick to say all of a sudden, such and such happened. Well, rest assured, if you want to interest investors, it will not happen all of a sudden. You have to create the circumstances you're looking for. And planting good seed in good soil is so apropos for this stage. The good soil is, as previously stated, a target audience that's right for what you have. Then the good seed is, first, an investor-grade business plan, one that is constructed to include all the information a sophisticated investor needs to seriously consider capitalizing the idea presented to them. Then you need an executive summary, which is a summary of the business plan, which is actually used for the marketing, not the full-blown business plan. That's how you start gaining interest in advance of providing the full plan. And then you need a pitch deck, which allows you the opportunity to show some sizzle. I highly recommend a 3 to 10 minute video pitch be included with your pitch deck. This is the kind of good seed that when planted in good soil is destined to germinate. So just know that this is only step 2. This is not where you seal the deal. It's your steps to show that you can be a serious player. Now is when you nurture the relationships. Now that you have targeted the right type of investors and provided them with the quality information that they need to keep you in the forefront of their minds, now you have to nurture the relationship. Clever and precise persistence is now what's needed, but it also needs to be relevant. Create reasons to call, email, or even visit your investor candidates. Use press releases, news articles, and company updates to keep them informed of the business milestones and industry movements. Create virtual business opportunity meetings and webinars where you can push the envelope in asking for the investment. Host face meetings for a select few of the interested investors to, again, ask for the check. This is the crucial moment that you've been building toward. Make it relevant and memorable, and make sure you have conveyed value before you stand in front of this crowd. Now you can talk about closing the deal. Be prepared with the right type of documents for the deal you seek. This is what investors do for a living. So don't get to the finish line, then show them that you were not aware of the paperwork necessary to close the deal. This goes back to learning my beginning conversation of spending some time to learn what you need to know to capitalize your business. Different deals call for different deal structures and different documents. And these are legal documents that all parties will rely on moving forward, especially if the business goes south. Even if you are working with an attorney, you need to understand the following. What are and what's involved with a term sheet, letter of intent, private placement memorandum? What is a subscription document or a prospectus? What kind of reporting is required after you close the deal, whether to regulators or the investors? So you can see the end is just as important as the beginning, but none of this is hard. It's just a matter of learning the process. Once you know it, you are ready to fully capitalize your business at every stage that finance is required. When you keep your early investors happy, your subsequent raises get just that much easier because they will be there for you and will oftentimes bring their friends along. I hope I have met your challenge, which was to get you to want to do some research to figure out if investment capital might be the way for you to capitalize your business's financial goals. Thank you for hearing me. I know that each of you could have been spending time differently, and so I appreciate the time you've spent listening to this presentation. If you have questions, please visit our website, ibossinc.net, and select Send Voicemail at the left of the navigation bar.